Welcome to Money Matters. I'm David Kroll from Mortgage Network, and I'm with Emily Johnson from Polaris Capital, and we're going to try and make sense of the crazy big world out there and what impact it's going to have financially on Beaufort County, basically.
Okay.
We try to take the big
and beyond, slightly beyond,
and slightly
beyond.
We try to take the big picture and reduce it to the small picture and make sense of it. The big picture is particularly interesting this week. We are recording today the 16th of December, and we are now 5 weeks after the election. The big world is fascinating in financial terms and political terms. The rate of change in the bond markets is the greatest for 9 years. Interest rates in the home market have gone from 3.5 to 4.25 and are not stopping at this instant. The dollar is the strongest that it's been against other countries in the last 8 years. The dollar is, the strength of the dollar is going to have all sorts of consequences in the big economic picture and in the small economic picture. A very, very, very strong dollar means that it's difficult for U.S. companies to export because our goods become much more expensive. It means that in the equities markets, it's going to be harder and harder for U.S. manufacturing companies to maintain earnings. It's going to be a difficult world there. It means that trillions are sticking to my side of the fence more, the lending and borrowing of money. It means that trillions and trillions and trillions of dollar-denominated debt that is out there is going to be hard to pay back. So if you're the government of Russia, which is a debtor nation, it owes lots and lots and lots of money. You can only pay that money back in dollars because it's dollar debt, it's dollar-denominated debt, and it's very, very much more expensive now. It's about 25%, 30% more expensive than it was.
Which was inevitable.
It was inevitable, but it's like a bill that you know is coming due, and then you really feel sad about it. You know, you know the kids are going to college. You've been not preparing for it for 7 years, and they finally go to college, and you go, oh my goodness, that's a big bill.
Right.
This is what the dollar rally means, and it's not going to go away.
That's what the dollar rally means from Russia's perspective. Everybody else that owes us
from
money.
China's
but
perspective.
From our perspective, even just looking at the U.S. debt, our debt, trillions upon trillions of dollars that we have borrowed, that rate is now going up. So we have to think about the fact that we're both the issuer of the notes and the purchaser of the notes, and what that's going to mean long term. And when you hear analysts talking about the debt conundrum that we're in now, it's not those analysts are not referring to Main Street mortgages like they were, or business loans like they were back in 2009, 2010. They're referring to our government and how we're going to slowly unravel our way, or hopefully in a healthy way, unravel our way out of our national debt. And that's going to be really, really interesting to watch. But in the meantime, so from a more micro perspective, or bringing it back down to your portfolio perspective, all of those big macro trends have big impacts on your portfolio. And hopefully you've had your funds invested here for the last 5 weeks, I guess, as the market's rallied 8-10% or so, and we're banging our head up on the 20,000 mark on the Dow, which I'm sure there's going to be people that are, it could happen today. It could definitely happen today. We're sort of inching our way, inching our way towards that. So it could happen. It's that rally is being led by financials in a big way. And years ago, we used to talk about how financials would lead the way out of our mess, out of our recession, and for a little while they did, and then they backed back off again because of a lot of reasons, partially interest rates, partially regulation. Now we're seeing the banks start to really rally again, and we're probably at least 1 percentage point away from, on the Fed funds rate, from banks really making money. I mean, right now it's sort of, we think they're going to be making more. Their balance sheets are much healthier. Mm-hmm. The spreads between what they can actually loan for I'm sorry, on the spreads on what they can borrow money for and what they can loan for are growing, so that's a healthy thing.
Yes, remember last week, Janet Yellen and the Fed increased the Fed funds rate by 0.25%.
And it was already
But
priced in.
Yeah, but it was already priced in. But they forecast 3 more increases for 2017 and had very sort of boffo positive remarks about the growth in the economy. So everything is tending toward an economy that's going to grow very quickly, but there are enormous headwinds to that growth.
Correct.
And the headwinds are that the economy could immediately become inflationary on the one hand, and that the government could run into an enormous debt crisis. The government's been paying 2.5% for its debt. It's suddenly going to be paying 4.5% for its debt. That means that the pie slice out of the entire tax revenue, the entire U.S. government, the pie slice that goes to the payment of debt, which is already,
I don't even know what
it's
percentage
an
that is.
enormous percentage. It's going to double.
Well,
It's gonna
and so we
double.
need the pie to get bigger, and there's of course there's arguments about how to make the pie bigger from a tax revenue side. But anyway, back to the markets and your portfolio. Strong dollar definitely means that you should have a little bit more exposure overseas. If you're still looking at value and income type investments, if that's where your head is, then there are definitely some value options overseas, so you can actually achieve some sort of a dividend while you're looking for growth. That would be one area to be looking at based on the strong dollar. The other, of course, is still looking at financials and looking at where that's going to go. European financials perhaps a little bit more challenged because of what's going on in Italy. So you might want to, which we could talk about that in the second half of the show. But I would say we're sort of like the United States and Europe and everybody else. We all kind of look just alike, just slightly, just tweaks here and there. But Europe, interestingly enough, is actually, they're also keeping rates stable, not decreasing rates anymore, which is amazing given what sort of difficulties they've been having. But they also are foreseeing, okay, things are going well in the States, things are going a little bit better globally, therefore we're no longer going to keep lowering our interest rates, we're going to at least keep them solid. They haven't raised theirs, but that says something about where they view too that their markets are going to be going. But the headwinds there, just like the headwinds we have with our national debt, they certainly have national debt problems. They also though have corporate debt problems over there, and they have banks that are much more tied to
the dollar.
Correct.
Yeah.
And so that could be something that really rocks the heck out of the market in the next 6 months or so, depending on.
Deutsche Bank had big problems last month, month before that were reported. Lord only knows what's going on behind the scenes with the increase in the value of the dollar.
Well, that and the default rate with the defaults within many, specifically Italian companies, and that debt is held by banks throughout Europe, not just Italy proper. So anyway, that's really interesting. So that looks a lot like sort of what we look like here, maybe a few years ago. So it's just repeating itself.
Then driving in today, I heard somebody on the radio talking about how investing in a specialized fund for Russian equities would be a great investment.
Well, it has been because of what's gone on with the currency.
But I wanted to ask you, and because the moment the dollar goes up, see, these are all different ways that a rapid increase in the value of the dollar causes dislocations here and there. A fund that invests in Russian equities is effectively 30% cheaper right now. Those equities are. So what does that mean to the investor? Does that mean that's suddenly a great opportunity, or is that still just like any other opportunity?
Well, most of those have already run. Most of those funds have run. But if you think that trend's going to continue under the new president, et cetera, then it might be a place that you could park a small amount of money. I mean, that definitely is considered more in the speculative range.
Speculative range,
yes.
yeah.
So I don't think that having investments in those types of, I'm forgetting what, that's not emerging market. What do they call that market now?
I don't even know.
I don't know.
No.
But investments in those types of markets, having some exposure is a good thing. But several of them have already run, specifically those Russian.
When you say already run, you mean that they got there ahead of this conversation and have already chucked it up.
We've had a lot of movement in the last 5 weeks. just
Yeah.
specifically in financials, in emerging market debt, technology. The S&P has run, and it's primarily technology and financials. So we've had a great run. But that sort of begs the next question that we can talk about in the second half of the show is, well, with all of those gains, do you now take it off the table, or do you then continue with your existing plan? Especially number one is the market's about to the Dow is about to hit 200,000 if it actually happens, and number two, if we're about to see a reduction in tax rates, what does that do? What do you want to do with your portfolio? So please stick with us. We'll be right back with the second half of the show. We can discuss some of these items.